Now we're going to move into U.S. wages, what is happening with wages going forward, prices in general, and just what is that movement or activity? How is that going to impact movement and activity for the U.S. consumer? So one of the things that, we've been talking about this a lot in terms of faster wage growth, and where are we seeing wage growth, where are we not seeing wage growth? And I think this is an important chart to really drive home just how little some of this wage growth is at some of the lower scale, and how leisure and hospitality is obviously elevated. But remember, these are the low wage side. So we're looking at lower wages getting a little bit better. And we've talked about that there are segments, there are pockets of strength, which is overall, it's not accounting for as much as we'd like it to, especially when you look at education and health services. Then when you look at professional and business services, we're just not seeing some of that that growth, if you will, in wages, keeping pace with the rising price. And it's a lot of different reasons. Like when we've talked about before how companies are hesitant to hire additional individuals just because they'd rather have those employees work longer hours and try to do more with less to protect against having to raise prices again. Because as you bring back a new individual and you have to bring them back at a higher wage or higher rate, that you have to move that cost somewhere. And that's becoming, I think, a much bigger issue over the longer term, especially when you look at purchase-only house price. So when you look at just the house index, so the house price index versus the average hourly earnings, you just get an idea of just where that disconnect is coming from. You can see the huge shift that continues to drive higher. And when you look at home prices, you can see how it's gone parabolic while wages are just really following this trend. And then now at this point, they're not keeping pace with inflation. And that's becoming a bigger and bigger overhang as we go forward. And we look at, well, can the consumer continue to spend the same way? Are they going to go on vacation? Are they going to continue to buy some things with discretionary cash? As you can see, just one of the basic components continues to get further and further away. Then when we look at the confidence board, if you look at consumer confidence, you can see that it beat estimates. It's getting closer to this elevated level, but not quite back to pre-COVID, but getting close. And this is with, news about some of the COVID cases. This is news about, with inflation. So it's positive to see some of this recovery, and it's across the board in terms of present situation, expectations, which speaks strongly to what the consumer is willing to do in the near term. And that's something, and it's a little bit of a disconnect from the Michigan's survey, which is why we're going to look to see, is that going to be confirmed? Is there some deviation, and what could be causing some of that deviation from one to the other? Now, let's just look at some of these surveys that have come out just in general. So wages didn't rise for 75% of workers during the pandemic. So I think this is, when you hear about people quitting their jobs and going elsewhere, I mean, this, I'm going to speak personally as well as what the data has showed, but it's hard to get a big salary jump. You typically don't get a quote unquote true up salary without leaving your company. You're going to leave that company and you're going to do it at maybe an equal or higher to title with a salary bump. And that's when you see the big turnover rate starting. Those are those individuals that are saying, I've been here, I've seen my prices go up, you haven't raised my wage, I'm going to go find someone that does that. And here's where I think it's going to be interesting, because when you look at all adults, 55% had it stay the same. And then when you look at decreased, 14%, 6% when you think about people that had been cut. But under 50,000, I think, is an interesting one to look at, because decreased a lot or decreased somewhat, you can see that there's been a higher cut at the lower end. So when you see wages increasing, how much of that is just taking back and then going up a little bit versus starting from flat and then accelerating? And that's when we had a chart 2 weeks ago showing that there's been a steady increase, but it's at the lowest level and it's just going up, measured in quarters, not dollars, when you're looking at those movements, which I think this helps put that into context a bit. So then when we look at job seekers with muted salary expectations, so the one thing too, when you look at all adults, so less than what you made prior to the pandemic, 24%, about the same as what you made prior to the pandemic, 44%, and more is 32%. So when you look at the expectations of higher pay are muted among active job seekers with those with less than college degree. So how we're seeing some of these movements, but the wage data, and that's why it's very interesting to look at, is very mixed, because in some spots you can see it's like, look, this is falling. In other spots, you're like, oh, it's up almost $1 per hour. And that's why it's always good to put this into national context, because there's and into industry context, because some industries, especially hospitality, is skewing that to the higher end in terms of the underlying. But then when you break it into its pieces, you can see that there's only really pockets of some of this growth. And actually, some people don't even expect to get paid more, even if they're leaving their job. It could be for a better title, better work-life balance, or what have you. So now when we look at this a little bit differently and say unemployed can't find jobs in their desired industries that pay enough. So let's look at, I cannot find available jobs or open positions. 36% said yes, but I don't expect this to keep me from finding employment for the rest of 2021. Now, open jobs don't allow remote work. 27% have said that yes, but I don't expect that to stop me. Yes, and I expect this to keep me from finding employment. I think this is going to be interesting because open jobs are not within my desired industry function area. You're seeing that being a bigger issue. And then open jobs do not pay enough. 35% said that is an issue but won't stop them from finding employment, where 23% said it will stop them. So this is just looking at, of those unemployed and actively looking in the last 4 weeks. This is I think an interesting dynamic, because we're seeing some of this conflict of, not in my industry, so do you have the skills? And if you don't, I really can't pay you what you're asking because you don't have the skills that I want. I have to train you. So this is that friction point that we continue to bump against and keep talking about as an underlying problem. But when you look at the reservation wage that employers must offer to entice workers has jumped this year, and look at how much it's jumped. So that the average lowest wage respondent would be willing to accept for a new job. So let's just, what does that mean? So wages too are on the rise. So data from the New York Fed show that the mean salary employers must offer to entice a new worker into the labor force, known as the reservation wage, is up nearly $10,000 in the past year to $71,403. The Bureau of Labor Statistics found that Americans are leaving their jobs in record numbers, peaking at 4 million in April, in part because they see better opportunities elsewhere. Remember, if I'm stuck in a job that isn't going to pay me more, well, I'm going to go to a new position that's either equal or better than title, and I can get at least $10,000 more making that jump. So these are some of the things, and it's the average lowest wage respondent would be willing to accept. So it's the average lowest wage. So you may ask for 85, knowing that you'll accept 70 and settle at 75. So again, this is the average piece. So you're starting to see some of that, but it's not across the board. And it's very specific to wage class or income class, because you're not seeing it all the way throughout. So then let's take this to the Conference Board labor differential. So this is just showing you just how tight that market continues to be, and just the amount of opportunities some of these potential workers have to getting a much better position. But we're still not really seeing this cross the finish line, which is why when we look at jobless claims, when we look at continuing claims from last week, they continued to trend higher. And I think this week is going to be important because we're starting to get towards the end of the seasonal component. Then you're going to have, people, summer individuals going back to college. You start to see that shift again. And I think this is going to be an interesting dynamic as we progress. And plus you have in September, the official expiration of all of the excess unemployment and unemployment benefits in general. So now when we look at just the consumer, so consumers' intention to spend has moderately improved over recent weeks after peaking in late March. March 28th was that peak. Search activity for a number of going out and staying in topics finally growing. Also could get nominal yields to revert higher over the weeks to come, barring some Fed fireworks, which as you can see is kind of just a kick the can event. But when you look back into 2020, you can see that there was a spike as we came out of July 4th for search activity for outdoors, and you're getting something similar, but it's muted. It's not at the same level or the same pace that we saw from July of 2020 because pricing is different. We're at the longer end of price increases without wages really following along the way, resulting in I want to go out. It's the summer. I want to see if I can find a deal, but I'm not going to go fly somewhere. I'm not going to drive 6 hours. Maybe I'll stay local. I'll drive 2 hours, go stay at a hotel there for the weekend. I'll go to the parks. These are some of those shifts. So again, this is kind of that, I think, showing some of the softness we expect in some retail sales, in some consumer buying, which again is going to put a little bit of a cap on that economic growth and some of that underlying oil and gasoline demand. So then when we look at what is making up some of these prices, because we look at import prices continue to trend higher, core goods continue to go up, core retail sales have come down, again, speaking back to some of the softness in the going forward, and then core services continue to drift up. So we're still seeing prices going up and retail sales coming down. So are we at a point now where the consumer's like, I've had enough. I have to wait. I have to wait for prices to come down because I just can't afford this. I'm going to wait, or I'm going to find a replacement. I'm going to do something, or I'm just going to buy less. And that's something that we've been seeing coming back into the market as these prices continue to trend much, much higher over that time period. And then when we look at what the market has done so far since Powell has started speaking, we are now up 8 handles and going to easily come into an all-time high again. So now when we look at what has happened in the U.S. and just some of the data sets, so we talked about PMI coming into coming into Friday. So the manufacturing PMI beat, expectation was 62, came in at 63.1. Services PMI missed by a wide margin, coming in at 59.8 from the 64.5. All of that is, again, both expansionary, but you're starting to see some of that softness. So new home sales missed, was expected at 796, came at 676. New home sales, again, percentage-wise was expected to be up 3.5%, came in down 6.6%. Dallas Fed manufacturing, we expected at 31.6, came in at 27.3. And then durable good orders, all of these also missed in expectations. Then you look at Case-Shiller, CoreLogic increases in housing prices month over month, 1.5 to 1.8. Year over year, 16.3 to 17%. Again, the home price index is at 16.61%, up 2% from April. All of these things continue to point to a much bigger issue over a period of time, with wholesale inventories missing estimates expected to be an increase of 1.1%, came in at 0.8%, with retail inventories expected to be at negative 0.5, coming in at positive 0.3. So you're seeing some of this. Well, some of the PMI is good, but it's being driven by a employment moving a little bit lower, activity moving a little bit lower, new orders falling a bit, and prices continuing to either go up, stay flat, but again, not coming back, not transitory in the way that is being talked about. So then when you look at the consumer confidence for major appliances has spiked, but this comes at the same time as the desire to buy a new home has gone through a floor. So the difference, so when you look at good time to buy, good time to sell. So good time to buy has plummeted, good time to sell has gone up. Well, if I'm not going to sell my home because I don't want to buy a new one, well, I'm going to go replace appliances. I'm going to make myself happier in the home that I'm in. So it's interesting to see that as you get this drop in home, good time to buy, you get a spike in good time to buy appliances. So that's something that will put some support into durable goods as you maybe see that next wave of of maybe home improvement or just upgrading people's living situations. So the slight uptick in jobs plentiful component of July consumer confidence index remains just below its July 2000 high, which again is showing just some of that bifurcation that we continue to see in the market. But now let's look at PMI. So we talked about the PMI before. Market, the supplier delivery times are still at record worst times in terms of just things getting longer and longer. Output prices continue to trend up, up again for June and July. Input prices, again, output prices, input prices, all of them are trending up. There is nothing that is showing it is stopping, it is pausing. We go into containers, we go into the supply chain, we go into rates. None of this is slowing down. So again, it comes down to when is this deemed transitory officially, or when do we just admit that it is not transitory in the slightest? So then when we look at composite PMI and US GDP, you can see that there's obviously the composite PMI has come down a bit, but we expect to see some of that support coming into the US GDP for this quarter. So, short-term capacity issues remain a concern, constraining output in many manufacturing and service sector companies, while simultaneously pushing prices higher as demand exceeds supply. However, we're already seeing signs of inflationary pressures peaking, with both input costs and selling price gauges falling for a second month in July, albeit remaining elevated. So again, on some service side, you're starting to see some of that slow down. But now let's flip to the other side of the equation, where inflationary pressures and supply constraints, both in terms of labor and material shortages, nevertheless remain major sources of uncertainty among businesses, as does the Delta variant, all of which has pushed business optimism about the year ahead to the lowest seen so far this year. The concern is this drop in confidence could feed through to reduce spending, investment, and hiring, which we've already started to see in the system so far. Now let's look at what's happening with ISM manufacturing new orders. So you can see that the city U.S. Economic Surprise Index continues to weaken. It's now negative. So economic data no longer coming in stronger relative to expectations per city's index. U.S. Economic Surprise Index, which is now in negative territory. Some survey-based data still strong, as shown by ISM manufacturing new orders. Both have tended to move somewhat together. So here, the new order data, and when we look abroad into some of the new export data, you're starting to see it soften up a bit. And there's still a backlog. There's still, people are concerned about lead times. So you're still seeing some of this ordering, but we expect this to roll back down, to the ISM new orders to roll a bit. Again, still being in expansionary territory, but just normalize a bit as backlogs continue to grow and they look to manage that. And why is that an issue? Well, ratio of non-farm inventories to final sales, has now dropped below the financial crisis levels, and then the ratio of non-farm inventories to final sales of goods and structures is historically low. So we continue to talk about inventories at record lows, which is why you have no choice as a company but to to go out and buy, to get some of these orders through, to replenish your inventory, which is why some of those new orders are going to stay a little sticky, because they still need to try to replenish what is happening in their inventory levels, which is why school, as we get back to school, you're seeing an increase in spending expectations, because people have either gone through their supplies. Now instead of being at home, they have to go into school, and they need additional capacity. So we will see this be supportive of spending, but this is also going to stress the supply chain a bit more, because how do you get all this stuff but from the coast? So again, that's why you're seeing some of these fear factors coming into play. So now let's break it into some of the regionals. So Dallas Fed manufacturing cooled in July to 27.3 versus 31.6 estimate and 31.1 in the prior month. New orders were up marginally. Production and hours worked up. Outlook, shipments, delivery times, prices paid, CapEx, all down but still expanding. Again, that's when we look at prices where they're continuing to go up. They're not going up at the same rate, but they're still rising, because remember, anything above 50 is expansionary. So we're not deflating, we're still inflating, but it's just at a little bit of a slower pace. and employment was still expanding. So here's where you can kind of see the general business activity cooled a bit, but still elevated, and the number of employees came down. And this is what we've been talking about, they came down. We just don't expect them to come back up, but really stay sideways. So still growing, just at a moderate pace to what we think could be a little bit of a cooling off into August. So then when we shift this into manufacturing index, came down a bit. When you look at prices paid for raw materials, pulled back just a tiny bit. Again, it's nice to see it stop going up, but still hasn't come back. It's still at these record levels. And then when you look at the average work week, still remains at near record levels, but their hiring has slowed. So again, asking people to do more so you don't have to hire that additional person, keeping some of that unemployment data elevated in general. Kansas City Fed manufacturing on the other side, survey was for 25, came in at 30. So you can see that it's still elevated. Manufacturing production right back to the highs. But then when you look at manufacturing prices paid, still very high. Prices received pushed to a new high. So anytime we get a pullback, it's almost like a spring load and it goes to a new high from that point. And that's, I think, some of the bigger concerns right now, where you're just not seeing any of this deflationary, or as Powell described it, moderating prices. If anything, you continue to see this going back up. Now taking this to the next level on Kansas City, your backlog of orders, a new record. And then when you look at prices received expectations, also a new record. So your backlog of orders is going up and you're charging more for it. So again, we're already looking forward. Now this is projecting into the future, where expectations are for prices to go up again. Richmond Fed manufacturing raw materials inventory, all-time low. Richmond Fed inventory levels of finished products, all-time low. Again, all of these things just keep companies beholden to and price takers, which means they're going to have to pay higher prices and they're going to have to try to pass that on while trying to manage their costs in other areas, i.e. employment and hiring. So then when you look at manufacturing prices paid, new all-time high. Richmond Fed manufacturing prices received, new all-time high. I've yet to see moderating as we go through these data sets. Now, when we shift a bit and look at economic sentiment index, you can see that we've actually started to come down a bit. And this is weighted a bit more to some of the sentiment when you look at sales, when you look at inflation expectations. You're starting to see some moderation because there's some concern. And again, you're not coming into this huge collapse, but you're starting to see people a little bit more concerned about jobs, a little bit more concerned about their wages, about what is spending going to look like. And I think this is going to become a bigger issue over time, especially when you look at the breakdown. So sentiment index for new homes, obviously at a low. Personal finances still at a high, just because you had, again, that benefit of transfers. New job, same thing. But then when you look at major purchases also coming down, and it's pulling the U.S. economic view down as well, which I think is going to be something to consider as we get out of Q2, which Q2 GDP comes out tomorrow. So we'll talk about it on Friday, but you're starting to see some of that moderation in terms of what those expectations are going to be. Then when we turn and kind of wrap this up into its nice, neat little bow, you can look at just what that composite all industry PMI looks like versus the developed market. Output has come down. Future output continues to come down. Again, pointing to some of this slowing in just general output, still expanding, but just at a lower pace than I think previously expected, which again is just going to moderate some of that growth expectations that we're seeing in the market on those estimates. So now in the next segment, we're going to go through just how are people shopping a bit differently, and then go into a deep dive on homes, home prices, real estate, to see where we sit and where we expect things to go from here.